Good morning, everyone. My name is Willa Smith. I am a business advisor here at the Small Business Development Center at Stony Brook University. Also a former commercial lender. So I'm here to talk today about finding the money that you're looking for, or how to prepare yourself and your business for finding the money. We're going to go through a lot of different topics this morning in this presentation. Please feel free to use the chat to post any questions that you may have as we go along. I'll try to stop along the way and answer questions, or we can wait till the end and see if there's anything at that time. Just a little bit about us. If you're not familiar with us, we are the Small Business Development Center. We work with small businesses of all ilks and all types and all industries, and our main goal is really to help you succeed and be more successful with your business. We're objective, so we can listen to the issues that you're having, and we're not mom or dad or friends or family, so we can give you some sound advice, hopefully. We have a great research network that also provides all kinds of information and research, all free of charge to you, to help you develop and grow your business. And that's what we're really all about, is helping the small business community survive and thrive in these challenging times, quite frankly. So we're going to first talk about why people usually look for money. Lots of reasons, right? I've listed some here. Maybe you're looking to expand to another location. You're thinking of franchising, either buying into a franchise or franchising your own business. Upgrading your systems and equipment, that's a very popular one these days. Looking for a marketing plan, developing your website. You want to hire someone on the outside maybe to do that. Maybe you have a new product line that you'd like to invest in and put out on the table. Big one is commercial real estate. People like to buy a place to have their own business, and that's a very big goal of a lot of business owners. Maybe you want to buy another business that's similar to yours, or that complements yours, or one that you have experience in and would like to take ownership of. And the most common one we hear a lot of is starting a business. What does it take to get the money to start a business? Okay, so let's talk about some of the lending products that are out there, because there are gradually different types of loans and sources of capital that you may want to access. The most basic one that most small businesses get is a business credit card. Doesn't have the best rates, as we all know in our personal lives. It can be high, but the idea of a business credit card is to give you quick access to money that you're going to pay back, hopefully soon, within a year. For sure. So we call that a short-term asset base there. So it's basically going to be like you use it in your personal, you're going to get it in the name of the business, and you're going to start to build up credit for the business. When I think about starting a business, it's almost like having a child, right? So you're in the beginning, you're going to be the parent, and you're going to be feeding a lot of your money into the business. But the goal is to get this child to grow up and be able to live on its own. So getting its own credit card, just like a child getting his first credit or her first credit card, it's the same kind of concept. So we look at a business credit card as the first product that comes into a business. And it's very, very helpful to have that and to be able to get the business to have its own credit. A line of credit is a little more formal. When you work with your bank, you're going to think about maybe getting a line of credit that they give you $50,000 and you borrow against it, you pay it down. Banks have different terms for that, but generally speaking, they want to see a pay down of at least half of what you have outstanding every year, and that's what they consider good behavior. So if you exhibit good behavior with your business line of credit that you got through a bank, then they will increase the amount of money that is available to you. So as time goes on, you get a bigger and bigger line, and that helps you grow and expand your business. A term loan is basically principal and interest payments over a period of time. So you're going to borrow a set amount of money. Let's say I want to buy a new refrigerator for my business. It costs $30,000. So I'm going to get a loan for $30,000 and pay it back over 3 to 5 years, let's say. So that would be what a term loan is for. It's usually for equipment. You can also use it for acquisitions for up to 10 years. Typically term loans, when they talk about a term loan at a bank, they're talking about a short-term principal and interest payment. So you'll be able to budget it and you'll be able to work it into your cash flow. The last one on there is the commercial mortgage. Now that would go from 10 to 25 years. That's like you have for your own home if you have a home. And there's going to be a full underwriting going on with that. They're going to want to see that you're putting money into it. So that's for a more mature business, but it's definitely a goal that everybody aspires to, having a place of their own. Usually a commercial mortgage would be on a building. The business owner will set up a separate real estate holding company for the building, and that real estate holding company will lease the space to the business. From an accounting point of view, that's generally how it's done. Okay, so what I thought we would talk about a little bit is the business lending team. Number one is us. You want to have a team of partners that can help you get ready to get financing. So the first one is we see a lot of people very early stage when they come in looking for money. And we ask a lot of questions and try to see where they are in the process and evaluate how ready they are to present themselves to a lender. But aside from that, there's also your bank branch representative. When you go and open your account, you're meeting people, and those relationships are key. You really want to make sure that the bank knows who you are and that you're starting a business, and that that relationship needs to grow and is really beneficial. So you definitely want to invest in knowing the branch and getting them to know you. I suggest going in and introducing yourself to the branch manager when you open up a business account. You may also be introduced to a business banker in the branch, and that banker is specific to business. So they know all the products that they have, like merchant services or point of sale systems, all the different credit cards, all the different types of savings accounts and checking accounts that could be available to you. So they are also a very key player on your team. In lending, after the business banker takes in a loan application, they send it to a loan underwriter, who then gets reviewed by a chief credit officer. We're going to dig a little deeper into this. And of course, the loan processor and servicers, the people that you're going to call after you get the loan. So let's look at the bank branch representative. This is someone in your community, which is very important to connect with a branch that knows you, can see your business, and starts to feel a connection to you. They are typically interested in building their deposits. So they're going to be looking for how much money and revenue is coming in, and they're going to want to help you in any way they can to connect you with people in the community. You'll see bankers like this at Chamber of Commerce meetings and networking meetings. They also, like you, want to make a lot of connections so that people know who they are. They will probably be the first person that when you go in and you say, I'm looking for a loan, they will kind of talk to you a little bit and see what you're looking for and determine where that should go next, whether it goes to the business banker. If it's a small amount, they may do the loan themselves, but they're going to talk to you about the next steps in the process, and they're going to troubleshoot account issues that you have, which a lot of people, when they have checking accounts for business, they have issues because, you know, they're writing a lot of checks. They may be taking money in from vendors and from clients. So sometimes there can be issues. So it's really, really important that you know who this person is and that they see you as a friendly partner on their team as well. Let's talk about the business banker. The business banker is a little bit deeper and more specialized for businesses. It's interesting, during COVID, we had a lot of loan programs. I was a disaster relief specialist, and I would always ask, oh, who's your business banker? And 9 times out of 10, people just looked at me and said, I don't think I have one. And it's really important to have that relationship. And they come in different levels. So a business banker in the branch handles revenue up to a certain amount, let's say $1 million in annual revenue. So they know all the startup products. They know how to get you going. Once you get more revenue going, you're going to be assigned to a more graduated business banker. And those people are going to be able to handle bigger loans and look for bigger opportunities. And that is a progression that comes through with a business banker. They also are people that write up what they call an opportunity memo. The opportunity memo is describing what you're looking for, how you're going to spend the money. And we'll get into this a little further when we talk about business planning. But they need to know who you are and what you're all about so that they can advocate for you when your loan application goes to the underwriter. Let's go to the underwriter. What do? They perform due diligence on your loan. They make sure that you can afford the loan. You may think that they're wrong, but you have to remember that these people are investing in your business through a loan. They're not actually getting equity in your business, but your success depends on whether or not they can get repaid for their loan. So they are on your side, believe it or not. They want to lend. They get credit for lending. So it's not that they're trying to decline people. They really want to make sure that this is a loan that's going to be repaid. So that they're always going to analyze the risk involved with lending to you. They're going to try to find some mitigating factors, reasons why maybe it didn't look good, but what about this, what about that? And they will try to be on your side when it goes to the underwriter. They're going to recommend, in the more advanced stages, they recommend approval or decline when it goes to the underwriter. So they're really important people to get to know and to present the best possible image of your business. The next person is the Chief Credit Officer. And it's important to know that they are there because they manage a portfolio of loans. And most businesses go to a bank and the bank has an appetite. What does an appetite mean? It means that if I'm always lending to restaurants, I'm going to want an accounting office or a law firm or something else to kind of blend my portfolio so that all my risk isn't in one industry. So they are people that look at it from like a bird's eye view down and try to see and manage the risk for the bank so that the bank doesn't have all of their loans in one type. They want a nice diverse portfolio, not too much concentration in one particular type of business. And they are the final arbiter, if you will, on the bigger loans on whether or not you get approved or declined. And the last one on the team at the bank level is the loan processor and the loan servicer. So the processor is going to be calling you, asking for documents, seems like an unending number of documents, but they're going to make sure that your loan package is complete before it goes to the underwriter. And also after you get the loan, they're going to be the ones to tell you how you make payments, how you make prepayments, when does the loan end, all of that. They're very helpful with that. They also reach out to businesses once a year to get your tax return and to update the file that you have with the bank. So the next step is you're now going to apply for business financing. And as I say here, you only get one chance to make a first impression. And just like you interview for a job, you want to show up looking your best and having all your ducks in a row, because this is really going to make a difference whether or not you have that access to capital that you need. So let's look at the loan package. It is a lot of information, but everything has a place and a reason. So when they ask for this information, it's not just to harass and aggravate you. It's really used to underwrite your loan. So first of all, when you're a small business, your personal tax returns are going to be requested. Why? Back to that parent and the child. The business is the child that's trying to grow and you're kind of supporting it. So they want to see how do you behave as an adult. Do you pay all of your bills on time? What does your credit look like? Do you have income coming in to your household that could possibly help if the business doesn't do well? Then business tax returns. If you're a startup, you're not going to have business tax returns, but anybody that's in business is filing taxes every year, either as a part of their personal return or separately for the business. The IRS Form 45016 is a specific form that requests verification of your tax returns in the form of a transcript. So whatever you give the lender is going to be verified by going to the IRS. The bank will go to the IRS and say, can you send me a transcript? They're going to match it up to what you gave them, make sure that there aren't any numbers that are different, looking out for fraud, making sure you're being honest about what you're submitting. And the last thing is a business debt schedule, which is what kind of expenses does the business have, and what should I consider in addition to the payment of the new loan that you're going to be applying for. When you go to the lender, a lot of times if you're a newer business especially, you're going to need a write-up of some sort about what this business is all about, and whether or not you've done your due diligence and that you really know what you're getting into. Who are you? How long have you existed? What are you looking to do? What's your experience in this type of business? The most important part is the executive summary. As a lender, that's what I usually look for, to summarize the plan. I wasn't looking for a big book with lots of pages and tabs and all of that. I really wanted to just know those questions. Who are you? How long have you been in business? What are you looking to do? How do you think you're going to get there? Do you have any understanding of what you're doing and what your market looks like? It's basically your elevator pitch for the lending opportunity. And this way, the underwriter also can get very quickly acquainted with a large amount of material without having to go through it all. So if I see the executive summary and it sounds pretty good, then I'll probably move on and start looking at the actual financials to back it up. So the business plan has the executive summary. It has a company description. What are you? What's your business entity? LLC, S Corp, sole proprietor. Market analysis is basically where are you doing business? What does the competition look like out there? What other factors may come into play that may impede your success, let's say? Organization and management, who are you? Who else is working in the business? What is their bio? Do you have a resume? Have you been doing this for a while? Do you have customers already lined up dying to do business with you? That would be great. What's your service? What's your product line? Marketing and sales, how well are you integrated online? Do you have a website? Social media marketing? Where are you in that whole thing? You should at least have a plan for how you plan to do that. And then the sources and uses of fund statements, the funding request. You want to show all the money that's going to come into the business for this opportunity and how it's specifically going to be spent. So it's kind of a balance sheet. You want all the money, whether it's from the bank, from yourself, from friends, from family, wherever you're getting the money, you itemize that. And then you say, this is how I'm going to spend that money. So the two should, the expenses and the income should match, right? It should be dollar for dollar. If I'm taking in 100,000, how am I spending 100,000? So that's called a sources and uses of funds statement. Financial projections are actually a way of showing the bank what you expect this money to do for your business. So if I am buying that new refrigerator, that's going to increase the capacity of the business. And this way I can sell more and I can get more opportunity to come to me because I have the capacity to deliver on it. So financial projections and the entire business plan is really a specialty at the Small Business Development Center. We have a guide that we give to people and we go through it with them. You can either do it online, piece by piece, and work on it that way, or you can take a paper guide and go section by section. But again, we're not looking for long, expansive stories. We just want you to get to the point. What are you planning on doing? Have you thought this out? And the better prepared you are with your business plan, even if it's all up here and you're not a startup and you just have an idea of what this is going to do, putting the pen to paper and just writing out exactly what you're planning to do with the money is very, very helpful. And it shows that you've done your due diligence, makes it much easier for the lender. In the appendix, we're going to put supporting documentations, maybe ads or promotions that you've done, research and data, which you've gotten from us maybe, and you want to include that in the back, like a book has a library of information and resources that went into the book is always at the back. So your resume would be in there as well. So that's your business plan. It overwhelms a lot of people, but basically it's your story. It's your expanded resume, if you will, of the business. So it's very important to have something when you go to a lender that shows that you've done your homework and that you're ready for this lender. So some tips, if you need help, start small. Don't overcomplicate things. Don't get overwhelmed with it. Focus on what your audience needs. In this case, it's the bank. What is the bank looking for? They're looking for a lending opportunity that will repay them. That's the most important thing. They're managing risk, and they don't want to give money out with no expectation of getting it back. They also have other people at the bank that they have to make an argument for you. So you're helping them make that argument. If you don't give them anything to work with, then they're going to say, I don't really know about this business. They came in, they want money, but they don't know what they want. They don't know how much anything costs. I don't know. Should we give them money? Would you give them money? You know, that's really what you have to look at. If this were my money, and you came to me and asked me for $50,000, what's my first question?
How are you paying it back?
Right? So I want to know, you know, has this person really done their homework, or are they just looking for money to do whatever with? So being more specific and presenting a good first impression before you go to the bank, that's what we're about, is trying to get people ready so that when they go to the bank and they're introduced to a lender, they're ready for that. Write what you know and research what you know. My favorite expression, as everybody knows, is those who know best know how little they know. So don't come in thinking that you know everything, because there's a lot to know. And the more you know, the more you realize you don't know. So it's really important to kind of look at the demographics of your area. What kind of competition is there? What's within a 10-mile radius if you're a store? What other people provide your services? What makes you unique and special? How are you going to draw people into your business? And remember, it's not just about getting funding. It's all about you and clarifying your business idea for yourself and for your business partners. And the bank is a partner because they are giving you money, or any lender. It doesn't even have to be a bank. It could be a friend or a family member that wants to invest in your business. The respect there is, I'm going to take good care of your money. I'm going to make it work for this business, and we're going to grow, and we're going to have fun doing it. Okay. The next thing I want to talk about is just really quickly, to give you an idea, there is an actual federal law called the Equal Credit Opportunity Act. It's called Reg B. And the reason why I bring it up is that once your loan package is considered complete, meaning all those documents we talked about are in the package and it's ready for underwriting, for someone to review it, they have 30 days to give you a decision. If for some reason the underwriter sends you questions, that stops the clock, just so you know. But a lot of people say, oh, they haven't gotten back to me. It's usually because they're waiting for information, and so the clock has stopped. They are, under law, supposed to get back to you within a 30-day time frame from the time they've gotten all the information. So the next page shows the application process flow. So it goes into underwriting. At that point, the underwriter is going to do a quick analysis. They have spreadsheets that they pull together with all of your financial information, and they look for some questions that they may have. They'll probably send you an email saying these are some questions. You want to get back to them right away, or hop on a phone call with the underwriter, and we can help you with that too. A lot of times we get on the call as well and help you position everything. And hopefully you get that all worked out. Works out great. You get approved. You go to what's called post-approval, where they put the loan documents together, and then you close. If you're declined, you'll get what's called an adverse action letter, and they will hold that letter for 5 days to give the business banker time to speak with you about it. My feeling about this is, if you are declined, I do not look at that as a negative. I look at that as an opportunity, and that's the way you should look at it. It's never a negative to fail in that respect, if you want to call it a fail. It's saying, okay, that somebody else looked at this opportunity. I gave them all of my information, and they don't feel that taking on this debt at this time is a good idea. Now, Could be other factors too. Could be the appetite of the bank. And so we do have other lenders that may be more welcoming to your business. That is true. But if you've gone to a couple of banks, 2 or 3 banks, and they're all saying no, there's definitely a reason for that. Sometimes it's the credit, and you have to work on that and get that in pretty good shape before you go to a lender again. Every time you go to a lender, they're pulling a hard credit report, and that is impacting your credit score. So you want to be careful. You want to really look at why you got declined and give an earnest attempt at that. I know it's disappointing and it's very upsetting for a lot of people. They get very frustrated because they really need that money to move forward. But it's better to take a look at that and say, what can I do differently next time? And let's work on getting in better shape so that the next time we go, we have a better result. So basically, all of this is really verifying your income, your assets, your debt, the project that you're doing. They are going to also look at their credit policy. They have guidelines, parameters that they're looking for. And I have worked at several banks now, and I can tell you that they're almost the same from bank to bank. Not a big difference. They're all kind of looking for the same thing, whether it's a credit score above 670. What does that tell them? It tells them that you basically pay all your bills on time or pretty close to on time. If you have charge-offs or bankruptcies, that's going to be a problem. You're going to have a good explanation as to why that happened. And there are one-time things that do happen in people's lives, and underwriters are familiar with that. They need to hear that explanation. If you have a problem, like, oh, I went through a divorce, it was a really tough time, but I have gotten myself back on track. That credit problem was from a few years ago. Look at what I've done since then. So you can make an argument for that. Commercial banks tend to be more conservative and a little more risk averse. So a big bank like a Chase or Citibank or one of the big 4 banks, you know what the big banks are, they have a lot of opportunity to lend. That everybody's going to them. They have really great systems. Everybody's using them. There's a bank on every corner. So they can take the cream of the crop, and they do kind of filter out some of the smaller deals that they feel they don't have an appetite for. So for situations like that, you might want to go to a community lender, a credit union is very good, and then online. We'll talk about that more in a minute. But basically, all of this is just performing due diligence on the opportunity. And they're doing their homework on you, and you need to do your homework as well in this process. So the next little slide there is showing what it's all about. It's all about risk. They want to reduce the risk, or they want to transfer the risk to somebody else or something else. In some cases, they will accept risk or avoid risk. So if they want to reduce risk, they may look for a stronger personal guarantee or require you to put more money down so that more skin is in the game. That's a way of reducing risk. If they transfer risk, what they're doing usually in that case is they're putting a lien on an asset or collateral, like maybe your personal home. The SBA does require that if you get SBA financing, they take any and all collateral to mitigate a shortfall in collateral. What is collateral? It's an asset that you own. Could be your home, it could be a piece of machinery, it could be the business itself. But they will put a lien on that so that if the loan defaults, they have a way out. They have a way to get their money back. Sometimes they accept risk. And again, we have in the lending world, we call it mitigating factors. So if you have mitigating factors that are good, they will take that into consideration. Just like I talked about before, if you went through a bad divorce and it was 5 years ago, but you have now redone your life, they like to see you kind of on the other side of that, not while you're going through it. But if you're on the other side of it and you can say to an underwriter, yes, there are some bad things in there, but I have turned it around. And avoiding would be basically, you're too weak to approve you at this time. There's no appetite for you. Too much industry of this type is in their portfolio. They may tell you to come back in a year. after they see a little more growth with the business. And that's what you really want to find out. Like, how can I get this better? Because we're talking long game here, not short-sighted. So we want to move the business forward inch by inch and make smart decisions that are going to get us there. Okay. So we keep talking about they want their money back. There are actually what they call in underwriting 3 ways out. What does that mean? It means if I'm lending you money, I want 3 ways to get my money back. And so I'm going to look at 3 things. 1, I'm going to look at cash flow. What is cash flow? Well, at the end of the day, after all the money comes in and you've paid all your bills, how much is left over? That's my cash flow. And with that cash flow, I can do other things, right? So even in our own personal lives, it's really just common sense when you think about it. At the end of the day, you pay your rent, you pay your utilities, you go food shopping, and you have a little left over at the end of the month. What do you do with that? Do you save it? Do you go to Macy's and buy a new top? There's what we call discretion with that money. So they want to make sure that you have enough discretionary money in the business and possibly in the business and yourself personally to make this work. So cash flow is very important. It's really your excess funds available to make payments. Collateral. Nobody wants to liquidate your home, but they want you to feel like they will liquidate your home if you don't make your payments. Why? Because it kind of makes you work a little harder sometimes, right? If you know that something very important to you is on the line, you're going to take a lot of time to think that through before you take it on. You hear a lot from people, I don't want to put my home on. I don't want them putting a lien on my home. Well, what that really says is that you may not totally believe that you can do this. So you have to be careful when you make that statement because it kind of sounds like you're not all in. And it's important to be all in when you're looking for a lot of money. And the third one is the personal guarantee. So do you have other sources of income in your life, other ways to support you personally? There are 2 things that a lender looks at. One is the business, and the other is what they call a global look. And a global is the business plus the personal together. So it's fine if the business doesn't quite make it, but the global, including personal, is very strong. I might do that loan because I feel like you're going to throw the money in to make it happen if you have to. What doesn't work is if the business is strong, but it isn't enough to support you personally. That's going to be a problem because if that business goes bad, you can't live, you can't, rent your house or have a mortgage or anything. So they're going to look less favorably if the global picture is negative, even if the business is doing pretty well. Because what that tells me is you're bringing me a lot of money, but the business is sucking it all up and it doesn't have enough to pay you to live your life. But if you have other sources of income and you can throw that into the mix, that makes people feel a little better. Sometimes there's no collateral, what we call an airball, like when you buy a business. Business acquisition has what's called goodwill. So I'm going to use McDonald's as an example. When I say McDonald's, everybody knows what McDonald's is, right? So that brand has a lot of goodwill just because they're so well known. So that's kind of an airball. It's not something I can actually cash in, but I know using that name, I'm going to have a leg up from the hamburger joint down the road, right? Because people, if they see McDonald's and they see Willa's Burgers, they'll say, I don't know Willa's Burgers, but I know McDonald's, I know their menu, and I'm going to stop there. So that's what we call an airball, but it's got a lot of value. That's goodwill. And when you're buying a business, like if you're selling a business after many, many years, you assume that there's a lot of goodwill, that they're well known in the community, they've been around a long time. An electrician might sell his business and say, hey, I have this whole book of clients, all these people know me, all these contractors I've worked on for years, so I will give you my business. That's not a hard asset that has money, but it's worth something, absolutely worth something. So that will be considered as well. So let's talk for a minute about cash flow. I don't want to get into the weeds here. I'm not trying to make you into an underwriter. I just want you to understand what an underwriter will look at with cash flow, because you'll hear it a lot. Oh, there's not enough cash flow. I don't like the way the cash flow works out. What they're doing is they're taking your annual business debt. So let's say I have a business and I have a loan on the business for equipment for $300,000. I make payments every month, and basically that's my only formal debt. I also have credit cards that I pay every month, so I'm going to look at that. That's all going to go in my business debt schedule, and I'm going to get a monthly amount. What does it cost to be you, this business? What does this business carry every month in debt? Then I'm going to look at all of your income, which is really your net profit. After all the expenses, what's left? I'm going to add back in the interest from your loans, because that's coming out of the payments, and you don't want to double count it. Plus depreciation and amortization on your tax return, which are not real cash. So I can just put that back in because you didn't actually spend money for depreciation. It just happens. I'm going to come up with a number, and I'm going to divide it by that annual business debt, and it comes into a ratio. It's called a debt service coverage ratio, DSCR. And they want basically what they want is they want to see all that net income that I just described. They want it to cover your debt by 1.25 times. If you do SBA financing, it could be 1.1, 1.0 sometimes, but it can't be below 1, because that means you don't have enough money to cover your debt. So it's a scale. They want the income to be up here and the debt to be here, right? So you still have a little wiggle room there if something goes wrong. Now, there are some things that can impact cash flow, like let's say I had to get a new roof on my building, and all of a sudden last year I had to spend all this money, and that showed up. But that's a one-time thing. Maybe I moved my business and there were expenses involved in that move. That's not going to happen again. So I'm going to point that out to an underwriter. Maybe my partner left and I saved, now I'm saving his salary, and that can go back into income. So maybe his salary was on my tax return, but it's not going to be on my next tax return. So you want to make sure that you're telling people that. Because basically what they're saying is for every dollar in debt or liabilities, there should be $1.25 in money to pay, okay? And it's really a great rule of thumb when you think about it. If you think of it logically, it's all common sense. That's all it is. A quick look at collateral. You'll hear sometimes UCC1 lien on all business assets. Well, if you go to New York State website, you will see a lien search, and you can see on a business what liens have been placed. They usually have an expiration date, and then the bank will continue it if the loan is still outstanding. But basically, there's a pecking order, if you will. So let's say I took a loan with Chase, and next year I took a loan with Capital One. Capital One is going to come in second after Chase, right? So if I liquidate, Chase gets all their money, and Capital One gets what's ever left over. So these liens kind of pile up on a business, and a lender will look at how many liens you have and where are they in the pecking order. Are they first position, or are they somewhere down fifth or sixth? So that will have an impact. They also look at the asset that they're lending against. If you have accounts receivable, they will look at only the accounts receivable that's under 90 days. Why? Because when it's over 90 days, you're probably not going to collect on it. If people haven't paid you in at least 90 days from the time you gave them the product, probably going to go to collections. That's the rule of thumb anyway. So they'll take 80% of that, sometimes 75% of that number, and they'll consider that collateral. Inventory, 50% of inventory, the value of inventory. Why is that? Well, if I owned a lot of batteries, like a Radio Shack did at one time, or radios, let's use radios, and I have a whole pile of radios over here, it's not going to be as valuable as time goes on, because technology changes all the time. Hi, we have a person in the room. Three people. Hi. So all of these ratios change, and again, back to common sense. Inventory over time degrades, right? It doesn't appreciate, it tends to depreciate. In the food industry, it degrades pretty quickly, right? So you have to be very careful about your inventory, and a banker might look at that as something that they don't want to lend against because it's too quickly going bad, spoiling. Equipment is another thing that a lot of people put up. Equipment also, as you use it, like a car, as soon as you drive it off the lot, it depreciates. So they're going to look at the type of equipment, how long have you had it, what is the useful life of that equipment, right? So we always say, oh, my roof that lasts 10 to 15 years. Well, if your roof is already 14 years old, I don't know if I'm going to really be able to liquidate that and get anything for it. So that's how they're looking at it. Real estate is a very good piece of collateral. Why? Goes up, right? Over time, if you take care of your property, we have seen a lot of appreciation on Long Island, especially in the last couple of years. So real estate is something that banks really love to lend against because they feel that over time, as you make payments and the property appreciates, your equity builds, and they feel pretty sure that they can get their money back. So you will see a good appetite if you're trying to buy real estate if all the other factors are good. Again, there could be shortfalls in collateral, but there could be mitigating factors, which we talked about before. And basically the question is, does the collateral support the amount being requested? And if not, are you strong somewhere else? When we talked about the three ways out, the cash flow, the collateral, and the personal guarantee, if one of those is weak, but the other two are really strong, that's okay. It'd be great if they were all really strong, but you know, it's a balancing act between the three. So the third one we're talking about is a personal guarantee. Again, as your business matures and gets seasoned, sometimes you don't have to do a personal guarantee, but for the most part, in the small business world with lending, you're going to have to give a personal guarantee. And what that really says is I stand behind my business. I will be here and I will put my all into it. Whatever I have, whatever I own, you will have, because that's how much it means to me. And you have to think about that because it's possible that if your business goes under, they will come after you personally. It could happen. But basically, it's the skin in the game, right? They want to see that you have money available on the personal side to fill in the gap if there is a gap. Like during COVID, as we know, a lot of people had a lot of trouble. Once the revenue went down, their business couldn't survive. And that's why the government came in and threw a lot of money at the problem. But if government isn't there to throw the money at the problem, you're going to have to find your own resources to keep things going. So that's really where a personal guarantee comes in. And if you don't have a personal guarantee on the loan, sometimes it's priced much higher. So you'll pay a much higher interest rate for that kind of a loan, and that's not really a benefit to you. So they're asking that question: how much support does and can the guarantor provide? Credit scores. We all know that that's the lifeblood of lending, right? Why is that so important? Because you're asking me to give you money, and so I want to know, did you ever take money before? Did you ever pay it back? Did you ever default? Did you ever go bankrupt? You know, I want to gauge how respectful you are of the money that you take. And that's what a credit score is. It's made of different components. One is it's a history of repaying money, which I just talked about. It's the types of loans. So if you take a car loan over 5 years and you pay every payment over 5 years, never missed a payment, the loan ends in 5 years, I like that. That tells me that you knew how to budget that in your life and you got through it and you made a commitment and you did what you said you were going to do. On the other hand, if you have a credit card and I give you a line of credit for $10,000 and you go out and spend it on shoes and clothing and whatever, and 10 years later, you still haven't paid off those shoes and clothing, I'm going to say that's not really responsible. A credit card is a short-term loan, and it requires you to discipline yourself to pay that down. So if you start to max out your credit cards and you're not paying it down, a lender is not going to look at that favorably, and it will impact your credit score. In fact, you should have no more than 30% of your available line outstanding, because that will impact your credit score. So let's say I have $1,000, Chase gives me a credit card for $1,000. What I want to do is make sure that balance doesn't go over 300, right? I want to keep it below 300. I can go up over that, but then I want to pay it down as quickly as possible. That's what's going to impact your credit score. And by the way, there is a free annual credit report, and actually during COVID, they let you pull your credit even more frequently than that. At annualcreditreport.com. I know that a lot of the banks are also giving credit scores, but it was actually, I have a note here, it was free weekly through April of 2022. So I guess that's now, it's this month. But anyway, that's a pandemic benefit. But that is federally sponsored, that website. So if you go there personally, you can take a look at your credit and you can see what that report looks like. I do believe you have to pay maybe $10 for the actual score, but they will show you what's on your credit report, so you know before you go to a bank or what it's going to look like. The most important thing is to pay on time. If you're not paying on time, make a payment plan with a collection agency, or if you're in trouble, show that you're trying to get it right, correct any errors that you have. And that is a very important thing to maintain and to take care of. It can really impact whether or not you have access to capital down the road. Okay. 5 C's of credit. You may hear this here every now and then. They all start with C: credit, capital, collateral, conditions, and character. So credit, as I just said, is the most critical. It's an indicator of your future payment performance. Capital is how much money you have at risk if the business fails. Collateral, we talked about, it's a form of security. It's about quality of collateral, the type of collateral, the useful life of your collateral. Conditions is really what we're dealing with right now in the economy, right? For instance, I have a client that does carnivals. They were terrible the last couple of years, but things are booming in the carnival industry right now because everybody wants to get out and have fun and do entertainment. So I would say that's a pretty good thing right now for that industry. They're doing very well. So they're going to look at the economy and how it's doing from your particular industry. And the big thing is uncertainty, right? We're all managing uncertainty. We never can say for sure what's going to happen, but we look at trends and we say, what's the trend right now? The trend right now is the weather's getting better and people are trying to get out and do things, and they want to go to parks and they want to go to concerts and they want to do all the things they haven't done in 3 years. We can all agree that that's a trend, right? So any business that feeds into those trends is going to do better, and a banker is going to feel better about that. And then character is really the general impression you're giving to the borrower. Are you somebody who is responsible, who has built things over time and has a really good handle on what you're doing? That's really important as well. So we're looking at an overall positive impact. How many years have you been in business? How much do you have at that bank? Remember, we talked in the beginning about that relationship. Over time, you want to build your deposits so that they feel like you're a good customer and they want to be able to help you out. Strong sales revenue. If you're starting out, that's going to be hard, but try to show that your money is building, that your customer base is building, that more and more people are getting to know you. The strong credit score is big, and collateral. What's negative? Factors having a negative impact is how much debt you have. If you're going from bank to bank to bank to bank and applying and they're taking credit, and they're declining, that doesn't look good. Nobody wants to be the one that gives you credit after everybody's declined you. They're going to wonder, why didn't they do it? Prior bank charge-off. A charge-off is when the bank gives up on you repaying them. They charge it off and they will never do business with you again. So it's a really bad thing to do. It may be your only way out, but it will definitely harm you going forward. If you're currently delinquent and you're behind in your payments, that will be negative. And high-risk properties or industries, for instance, we get a lot of people that want to flip homes, right? It's a big thing. Buy a home, you fix it up, and then you resell it. And it's been a good market for that, but it's called speculative, right? Because we're not really sure how many homes you get started. It costs a lot more than you thought it would, so you don't finish the rehab, and now you're stuck with this home that's half done, doesn't get COs. You know, I can't really sell it, so now I've got a loan on that property. I don't live there. No one lives there. No one can live there. So that would be what I would call a high-risk property. A personal home, your personal home, primary home, is a good risk, right? Because you're living there, you're going to keep it good. People are coming in and out. I don't have to worry about it. Okay, and of course, business losses. So are business losses good for you? Well, I guess you don't have to pay taxes on money that you lost. But if you have year over year over year of losses, a bank's going to look at that and say, this person is not able to manage this business effectively. They're claiming losses every year. So they're going to have to fund themselves. That's what it's going to be. Like if you are claiming losses and you come and you tell me, oh, I have no real losses, you know, I just put that because it saves me on my taxes. Well, terrific. Then you should have a lot of money saved, right? You don't need to have a loan from me. The Bible is the tax return. So be careful. If your CPA is saying, oh, why don't we, take all these deductions and we'll claim losses, that can harm you if you want to go to a lender, a regular lender out there. So just to, weigh the pros and cons of that. Obviously, if you're just starting out, you're going to have losses in the beginning of a business. But over time, that should change. And everybody loves happy ending to the story, right? Okay, so aside from banks, there are online lenders. And back in the day, and I've been around a while, we looked at online lenders as like the place people go that can't get loans at banks, right? Because your first choice should always be where you have your money. So they should be the friendliest to you, but not always. Sometimes your particular industry, or maybe you're not in business long enough, they don't want to take the risk, and they can do anybody, so they just don't want to do it. So through the pandemic, though, the online lenders actually got a great opportunity to introduce themselves to the world, because the PPP loan program went through a lot of online lenders, and a lot of people got money from them. Some of them got in trouble because they overpromised and underdelivered, but a lot of them actually got better and stronger. So there are some. I just did a loan recently through the Lending Club, which actually the guy got pretty good funding. I mean, he was a pretty good case anyway, but I was surprised at how well done the loan was. He got an answer right away. It was a quick turnaround. He got a lot of money, over $1 million. So I was like, that worked out pretty good. So I've kind of changed a little bit of the way I think of them, but let's talk about them. First of all, the benefits. Online applications. Everything goes through the system, so they have everything online. No paper there. Quick turnarounds. Usually you hear back very quickly from them because that's all they're doing. They're not doing anything else. They're waiting for you to submit an application. They will accept less than stellar personal credit. So they have a little more wiggle room there, and because they're new and because they're trying to make an impression in the world, and they don't get the best opportunities all the time, they will take a little bit less than perfect personal credit. Low time in business. That's where a lot of startups will go, or short businesses. Some feature no collateral requirements. And sometimes you can go in and compare several offers at once from different lenders. So that's helpful. The downsides, they expect the money to be repaid pretty quickly. They want to get out of it quickly and minimize their risk that way. They have a high cost. Their rates are much higher than the banks. in many cases. Although if they're SBA lenders online, there is a maximum that they can charge. So that is a standard with SBA lending. So they cannot go above what the SBA says they can go above. So that's a protection there. Sometimes they have high origination fees, meaning to get the loan, you have to pay them money. I've seen interest rates of 9% to 80%. Pretty crazy. Sometimes they will take daily or weekly payments from your checking account. Okay, so they're gonna be aggressive in getting their money back. And of course, you're putting a lot of information out there on an online lender. So you've got to make sure that's a reputable person. You're not going to give them your social security information, tax ID information, all of that, unless you really know they're legit. You know, remember that with online lenders, another disadvantage, they're not humans. There are lots of automation.
Yeah, sure.
Trying to get someone on the phone. Not happening, right? Very hard. Something that through PPP is that people are like, I can never get anybody on the phone. They have a little chat box. Sometimes that helps. But it was really, really difficult to get an answer from a live person. So that's a downside. You can't walk into the branch and get somebody to talk to. I say stay safe because there's a lot of predatory lenders. So they will take advantage of people who are not able to get money anywhere else. So you do have to be careful, look for warning signs, unfair and abusive terms, and that's really what we're about, is helping you through that process. The high interest rates, fees that are more than 5% of the loan, avoid. Discover the annual percentage rate, which is all in. What is this really costing me? Because they can tell you it's 9%, but if you add in all the fees, it actually comes to 11.5%. So that's important. Do not lie on your paperwork or leave signature boxes blank. That's very important. You could get fraudulent lawsuits, things like that. And certainly don't get pressured into taking a loan. I get people that call me and go, I got this email from someone and it says it's at SBA.com, C-O-M. I go, that's not the SBA. That's a different, it's a scam. Run, right? So be very careful. Always hover over the web, the email address and make sure that it's a legit person that's trying to reach out to you, because they will get information from you, which the lending process does take all your information. So it's really important. So some final thoughts. Passion. What I love about entrepreneurs is their passion. They believe in their product. They believe in their business. They want to succeed. They want to make it work. But when you go for money, it has to be supported by facts, by the real deal. And your financials are going to be looked at and have to be strong. Complete loan packages. We talked about all the documents that go into a loan package. I really think they rule the day. When I get a package or a person that is willing to give me a lot of information up front and it really cares about their loan package and their impression, I look at it differently than someone I have to keep going, you didn't give me this and you didn't give me that. Remember I told you this, and then I'm chasing you constantly. I'm like, this person's not serious. This is really not somebody I really want to lend to, because what's going to happen when they owe me a payment? I'm going to be chasing them for that. Behavior is something that repeats itself. So declines can be a good thing. If you get declined, you're just not ready. It doesn't mean you're never going to ever get money. Okay, it's one of these factors I've talked about today is what's causing the issue. And so you want to look at that, remedy it, find out how you can make that better. And remember that it's all about timing and opportunity. So history is really your teacher. That's whatever happens to you, take from it, learn from it, grow from it. And that relationships still matter in this world of technology. So when people get to know you and your business and like you, and they see you in their community and they want you to succeed, everybody wants a good success story. So they still matter. It's important to network and to have people that think of you. And that's why people should use social media to keep themselves out there, keep reminding people of what you do and what you offer. It does matter. And that's it. That's my question. One last thing, on SBA.gov, if you're looking for a lender, there's what they call a lender match. And you can go in there and put some information about what you're looking for, and they will give you a list of lenders that will send your information, I should say, out to a lot of SBA lenders. Sometimes lenders in other parts of the country are more interested in doing the loans here in New York than the ones in New York. So be open to those kind of lenders as well.